Good day, everyone, and welcome to Module 5 of the analysis of the Nigerian Tax Bill. In Module 5, we'll be looking at Chapter 5 of the Nigerian Tax Bill. Now, Chapter 5 of the Nigerian Tax Bill 2024 establishes a detailed framework for the assessment and collection of stamp duties on various financial and property-related instruments. It is designed to streamline the taxation of dutiable instruments, incentivize compliance, and modernize payment and enforcement mechanisms to align with contemporary economic realities. Stamp duties traditionally used to record and validate transactions are extended under this chapter to encompass both traditional fiscal documents and digital financial instruments. By doing so, the chapter ensures that Nigeria remains competitive and efficient in generating revenue from domestic and international economic activities. So we'll be looking at part 1, imposition of stamp duties, which is under section 123. Now the scope, stamp duties are imposed on a range of specific instruments as outlined in the 9th schedule. Exemptions: certain instruments as detailed in chapter 8 are exempt from stamp duties to avoid overburdening taxpayers and to encourage specific economic activities. Now let's look at examples of chargeable instruments: bill of exchange, promissory notes, property leases, company share capital instruments, and marketable securities. Now let's look at means of payment under section 124. Duties can be paid using traditional method like fiscal tax stamps or modernized approaches such as digital tagging, electronic receipts, or any other method approved by the relevant tax authorities. Now these flexibilities accommodate technological advancement, making compliance easier for tax payers using digital platforms. Now, with respect to obligations to stamp duties or to stamp under section 125, instruments executed in Nigeria that are subject to duty must be stamped within 30 days of their execution. The responsibility for payment of the duty typically falls on the transferee of interest or the beneficiary of the service. Now, this provision ensures timely compliance and prevents disputes about who bears the responsibilities for duty payment. So, admissibility of evidence now. Under section 126, unstamped instruments cannot be admitted as evidence in civil proceeding incentivizing compliance. For criminal proceedings, unstamped instruments remain admissible, ensuring flexibility in prosecuting criminal cases. Now, the distinction prevents the misuse of unstamped instruments in civil disputes while maintaining flexibility for criminal justice. Now, for Part 2, chargeable instruments, bill of exchange now, section 127 include instruments like checks, drafts, and letter of credit, even if payment is conditional. Now, the objective of this is to capture stamp duty from financial instruments that facilitate significant payment transaction. So, bill of exchange include instruments like checks, drafts, and letter of credit, even if payment is conditional. Promissory notes, section 128, any written promise to pay a sum of money irrespective of conditions or fund availability is dutiable. This ensures that all formal financial commitments are brought into the stamp duty net. Options and securities, section 129. Contract notes for options to buy or sell securities are chargeable. Both buy and sell options are treated as separate instruments and charged separately. The purpose of this is to tax speculate and investment activities is to tax speculative and investment activities appropriately. So the purpose of this is to tax speculative and investment activities appropriately. Conveyance in conveyance in consideration of debt, section 130. Property transfers involving debt treat the debt amount as the consideration for calculating stamp duty. For example, if a property is transferred as security for a debt, the duty is calculated on the debt amount, reflecting the true economic substance of the transaction. Transfer of mineral assets, section 131. Transfer of mineral assets or interest are subject to stamp duties as prescribed in the 9th schedule. This provision ensures the government earns revenue from transactions involving valuable natural resources. On exchange of property, section 132. Section 132. Exchanges exceeding 1 million naira or an amount equal to the annual minimum wage are subject to ad valorem duty. This provision prevents the use of property exchange as a loophole to avoid taxation. Lease agreement, section 133. Lease of lands or buildings are taxed based on the term and consideration of the lease. Exemption threshold. Leases with annual values below 10 million are exempt to reduce burden for small scale transactions. Company share capital, section 134. Ad valorem duty applies to instruments related to company share capital or its increase. The purpose of this is to ensure that financial commitments by shareholders are appropriately taxed. With respect to loan capital, section 135, long-term loan capital such as debenture stocks is subject to duty, excluding short-term loans under 12 months. So this is to promote liquidity and support short-term borrowing without additional burden. Now, marketable securities, section 136. Duty applies to instruments for issuing securities by Nigerian companies, regardless of whether they are issued locally or internationally. This provision ensures Nigeria captures revenue from capital raising activities by domestic entities abroad. Now, for appraisal, section 137, real property appraisals are dutiable with the obligations falling on the appraiser. The purpose of this is to standardize valuation practices and ensure compliance in property transfer tax calculations. So let's look at part 3, miscellaneous provisions. Now we're going to be looking at duplicate and counterparts. That's section 138. Duplicate documents must either bear the original duty stamp or be certified by the tax authorities as duty paid. The objective of this is to ensure consistent enforcement across all copies of a document. Duty on multiple transactions in one instrument, section 139. Instruments containing multiple transactions must charge duties separately for each transaction, preventing bundling to avoid full duty payment. Now, multiple instruments for the same transaction. When multiple instruments effectuate the same transaction, only one instrument is fully charged, with others stamped as counterpart at a flat rate. This is to simplify administration and prevent redundant duty collection. So for multiple instruments for the same transaction, only one instrument is fully charged, with others stamped as counterparts at a flat rate. Now, section 141, which will be looking at non-monetary consideration. For instrument involving non-monetary consideration, the market value of the consideration is used to calculate ad valorem duty. So, for example, if a property is exchanged for services, the value of the services provided is assessed for duty. Now, the key takeaway here is comprehensive coverage. Number one, comprehensive coverage. The chapter captures a wide range of financial and property related instruments, ensuring that economically significant transactions fall within the stamp duty regime. Number two, flexibility in payment. Modern payment methods like digital tagging and electronic receipts promote ease of compliance, accommodating technological advancements. Three, revenue protection. Provisions addressing appraisal, multiple transactions, and non-monetary consideration prevent underreporting and enhance revenue collection. Number four, compliance incentives. The inability to use unstamped instruments civil in civil cases motivates compliance. The inability to use unstamped instrument in civil cases motivates compliance, and exemptions for small transactions reduce administrative burden for low value events. So in conclusion, chapter 5 of the Nigerian Tax Bill 2024 provide a robust and modern framework for assessing and collecting stamp duties, ensuring efficiency and fairness in the taxation of dutiable instruments. So, by balancing regulatory oversight with compliance flexibility, the chapter promotes revenue generation while fostering a business friendly environment. Now, the call to action for stakeholders is that it ensure all chargeable instruments are properly stamped within the stipulated time frame, leverage digital methods for easier compliance with stamp duty requirements. It is important to engage your tax professionals for guidance on transactions involving complex consideration, and this chapter represents a significant step towards modernizing Nigerian fiscal policies aligned with global tax practices and securing sustainable revenue from diverse economic activities. So that is basically the call for action for stakeholders. They should ensure all chargeable instruments are properly stamped within the stipulated time frame, and also leverage digital method for easier compliance with stamp duty requirement, and lastly engage tax professionals for guidance on transactions involving complex considerations. Thank you for your time. See you at the next module.